Hello, everybody. Welcome to Everything Trading, one of our webinars regarding gold. A lot of people trade gold, and there's a lot of interest in terms of, when is the right time to buy, when is the right time to trade. So let's just I'll just wait a couple of minutes before I get started. And we'll just wait a minute or two, and then we can get cracking. Just waiting for some attendees to arrive, and then we can get cracking. Let's put a timer on. Let's give it 1 more minute. It's already 2 minutes past 2 in London. I'll give it 1 more minute, and then we'll get started. Right. Okay. I think we've got everybody here. So why don't we get started? As I said earlier, we're going to focus on gold and look for some trading opportunities in trading gold. Now, when I talk about gold, I'm talking about derivatives, not the physical item. A little bit about myself. My name's Anil Kumar. I'm based in London, a director of Everything Trading. Just to give you a little bit of my background, just so you get a bit of an idea. I've been trading for 20 years, almost every instrument, futures, bonds, commodities, and Forex. Developed profitable algos utilizing mathematical models to trade. So we're not going to focus on algo. We're going to focus on technical trading, including looking at charts and indicators to see if we can find trading opportunities. Obviously, risk management is a very important part of trading, and once you focus on risk management, it will really help you with your trading. I also do other types of webinars and mentor students. As I said, I've been doing this a long time, and I do enjoy the process of passing some of my knowledge on to those that are interested. Before I get started, it is important that I just share this risk disclaimer with you, because everybody on this webinar should know that trading is risky. You should understand what you're doing, and make sure that you get advice and use reputable brokers and all the good stuff that you need to do, generally speaking. Today's sponsor for this webinar is TradeTorex. They're a regulated broker in the Seychelles, and you can see the Seychelles regulation number there. And do visit their website. And if you don't have an account, they're a great broker to use. So look, let's get straight into it. The first part of this webinar is really going to be theory, and some of you may already know this. And then, towards the end of the webinar, we're going to focus purely on charts. Whether you know anything about trading in terms of charts and what have you, I'll try to pass some of that knowledge on to you. But let's just focus on gold and the kind of things that influence the price of gold. Let me just move this out of the way so it doesn't obscure my screen too much. So I won't go into a deep history. I could spend a whole hour talking about the factors that affect the price of gold. And for the purpose of this webinar, we're looking at trading gold, CFD, derivatives, and therefore everything else as a technical trader, are important, but they're not the key things that technical traders use. But generally speaking, for gold, whether it's a futures, whether it's a CFD, whether it's the derivatives of gold, including ETFs and what have you, they are instruments based upon the physical gold that everybody knows and understands. We're going to focus really on technical trading tools, things like the basic stuff, support, resistance, moving averages, and some other indicators that will help you identify key turning points to help you understand when are the best opportunities to buy and sell. We'll look at a few different strategies, whether they're short term, longer term. And again, I could spend a whole hour talking about the type of trading, whether it's scalping or swing trading. They have completely different disciplines, completely different risk management, completely different sort of account size that you need for that. And that's not really the purpose of the webinar today. Today is really going to be looking at technical aspects of where we are with gold and how, we can take advantage of these opportunities. The other advantage of trading derivatives, leverage is something that you can utilize. We're not buying a physical amount of gold. We're utilizing leverage to, multiply the price movement depending on the kind of broker that you use, whether it's a low leverage broker or a high leverage broker. There's something to be considered when you are looking to trade gold. I'm not going to spend too much time on the fundamentals, but I think it's important that you get a bit of an understanding, right? And you probably do, but gold is a very unique commodity instrument derivative. A lot of gold is used for different things. I'm going to talk about the different things it's used for. And why is that important? Because one of the things that gold and trading gold has that, it moves in cycles. And those cycles are things like jewelry demand. For example, there's, when it's wedding season in India, the demand for gold goes up. Not necessarily saying that it's, that's the main driving factor, but these are all the things that kind of influence the price movements, even from a seasonal basis. Gold is also used as an investment product for storage of the physical, or whether the trading of the futures or derivatives. So all these things, are part of the demand cycle. The other supply part, we all know gold has a limited supply. Gold mining production. We all know, the volume of gold that's ever been mined. It's limited, and that's what makes the price of gold effectively keep increasing. And that's why I titled this webinar really on when to buy gold, because with a commodity that has a limited supply, it's unlikely for a long duration of time for it to keep falling. And again, the webinar is about the pullback, because in every whatever instrument you're trading, it doesn't move in a straight sort of 45-degree line. It moves in up and down cycles. And the up and down cycles are opportunities for us to find, trading opportunities. So buying gold, and be totally upfront with you, I'm a buyer of gold. I think gold has a long-term, upward momentum. And I don't just say that. If you look at charts going back, 20 years, year on year, it increases. Now, within those up cycles, there are down cycles, and we'll talk about those in a second in terms of how to sort of look at the market structure. We're going to look at trend analysis, some support and resistance, some moving averages, and some other indicators that can help us pinpoint when these turning points can occur to give us the best opportunity of maximizing our profit potential on trading gold. And we'll also look for setups. Once we get back into the charts, I want to get this theory part out as quickly as possible, and then we can start looking at charts and looking at different time frames. And depending on some of the questions I might get, I'll look at specific time frames. Whether you're scalping gold or whether you want to hold gold for 2 months, 3 months. And please, when I use the word and the definition of gold, I'm talking about CFDs and derivatives, not the physical. So gold, this is a price chart, and I could go back in any point in the past and probably in the future, and you will see these three basic concepts of the movement of gold. It's either in an uptrend, or it's going sideways, or it's a downtrend. It's only in one of those three cycles. And we'll look at charts shortly to see where we are currently. Are we in a down cycle? Are we in an up cycle? Are we in a sideways range? And how do we trade, depending on the part of the cycle we're on, basically. So before I get onto the charts, let's just get some base principles down. What is a trend? Because everybody can have a slightly different definition of a trend. And I just want to explain to you how I define a trend. A trend is when price of gold over a period of time is moving higher, and when it comes down, it doesn't go further than the previous high, the previous low. So it's created a higher high, HH, and a higher low. And every time it goes higher, and when the pullback happens, it doesn't pull back to the previous higher low. So this is how I define an uptrend, because when you look at a chart, you want to be able to sort of make a basic distinction. Am I up? I'm in an uptrend, downtrend, or going sideways? And depending on which one of those three things that I assess will be the decision-making process for when I decide to buy, basically. So if you look at a candlestick chart, which hopefully a lot of you will be familiar with, although it's not a perfect sort of cycle that I just showed you there, right? But you can actually see the higher highs, higher lows, higher highs, higher highs, higher highs, and higher lows. So from a sort of pure visual perspective, when you look at a chart without anything else on there, you can start saying to yourself, look, am I in an uptrend, downtrend, or sideways? And with every trend, as I said, price does not move in one sort of 45-degree angle. You get trends, you get higher highs created, and then a higher low is created, the pullback. And the pullback is, in my consideration, where I want to be looking to buy or rebuy or add to my buying positions when I get this pullback. Because, you don't want to be sort of buying up here, because when the pullback comes, you'll be going below your entry price. So identifying these turning points for me is very crucial. I trade the pullbacks in the direction of the prevailing trend, just to let you know where my thinking is. There are different types of traders. There are reversal traders. There are so many different types of trading methodology. But for me, I like the pullback. I don't want to trade, like, for example, the breakout. If I put a line here, it's breaking out of a previous high. For me, that isn't always favorable to the trader and to me particularly, because there's always a chance that prices could pull back below my entry price. And I try to avoid that. Look, can I do that 100% of the time? Of course not. But if your intention is to try to identify these turning points, then even if you are wrong, you've got an opportunity to minimize your risk, basically. And I'll talk about how, when we talk about stop placement and entry points, when we get further into this session. And of course, price, when I talked about it, doesn't always go up. You get times when prices are going down. And, now I'm looking for lower highs and lower lows, lower highs, lower lows. So every time the price cycles, it's cycling down. But the key indicator for me is that the previous higher low doesn't go above the previous high, basically, or the lower high, I should say. I hope that makes sense to everybody. And again, as I said, although this is the euro-dollar chart, it doesn't really matter, because prices move in a similar fashion regardless of the instrument. I'm just looking at euro-dollar chart here on a daily basis, but you'll be able to identify the lower lows, lower high. They're not perfect like this. I wish markets were perfect like that, but they're not. So you have to make sure that you understand, the objectivity of when you are trying to identify these lower lows and lower highs. And, this is the red lines of the downward, up, down, up, down. That's what price does. And this is a gold chart, going back to 22 to February of 23. And you can see what we're trying to identify here is we're trying to identify the turning points, because the turning points, as I just said, give me an opportunity to find out, is this the optimal entry that I can, place myself? I don't want to be, high up already in the trend. I want to try to get as close to the turning point as possible. Now, as I said, do I do it every time? Of course not. But that, if your intention and your goal is to do that, then you put all your focus and emphasis on identifying these turning points. And there's several ways that you can look for these turning points, and we'll discuss some of them, but there are other things which I won't have time to discuss, things like candlestick patterns and exhaustion and volume and other methods where when you do get a spike up and then it has enough and it starts coming down, what are the factors that are making that happen? Because if you know what the factors are, it can definitely help you in determining, when you want to, look for an opportunity to buy or sell. Although in this particular scenario, gold was going down, it found a base. We're going to talk about support and resistance in a minute, but all these clues, if you like, in the charts help us to identify when we want to be buying. Because look, ultimately, that's all we can do. We can look for clues in past price movements to see what might happen in the future, because ultimately nobody has a crystal ball. Nobody knows where it's going to go next, because there are so many factors that affect the price of gold. We talked about some of them, the supply and demand part of it, the holding of it, the government, governments that want to accumulate gold for all sorts of purposes, including, for exchange rate sort of controls and what have you. Again, all these are sort of economic factors that affect the price of gold, which we're not going to really spend too much time on. We're really going to try to spend time on how to just look at a chart and, identify these turning points, or hopefully find these turning points so we can, when we place a trade, we have a probability of success. So we've identified, or we've understood how to define a downtrend and an uptrend. Let's look at support and resistance briefly here, because again, I'll be applying all these things to charts as we sort of move forward into the session. Support and resistance. How to identify these levels. So look, again, this is just a euro-dollar chart, but we'll do a gold exercise in a minute. So what is the definition of support and resistance, and I'll try to explain that, what I look for. So you can see here, price came to this level, which I've drawn, obviously, after the fact, that I can see that resistance, price could not go higher in this example at this level here, and it tried again, and it tried again, and then it gave up. It did a similar thing with support, but let's just focus on resistance. So what resistance is really telling us is that buyers are not interested in buying gold or whatever the instrument is at above this price. They find this price to be, and again, I could spend a half an hour just talking about supply and resistance, supply and demand, because ultimately, anything that anybody buys, a buyer will attach a value to it. If that value is too expensive, they will not buy it. And if enough people do not buy it, the seller has to reduce his prices so that buyers can come in. And, again, it's a whole topic in its own right. And I do webinars on that aspect too. Just make sure that I've got everything here. And by the way, do feel free, if you want to ask any questions, just put them in the chat box, and they'll make my way to me and I'll try to answer them. So this is resistance. Price going up, can't get higher, comes down, can't get higher, comes down, can't get higher, and eventually price has to come down to attract more buyers. When we were at the support side, prices came down and buyers were waiting here. The sellers stopped selling, the buyers started buying. And that's what we're looking for. We're looking for clues to tell us that price underneath this level is not an attractive place, or should I say, it is an attractive place for buyers to purchase, because purchasers want to buy, in this example, the euro dollar, but whatever the example is, they want to buy, and you should want to buy at the most favorable price. And the favorable price is down here at support, isn't it? just move this thing that way. And support is here. So price is being supported at its level. Buyers are coming in. The sellers try to push the price down again, but every time price, and I'm pointing to these red candles that are large red candles that are coming down, trying to push price down, but buyers are there to buy, and that's what creates this sort of buying momentum. We still have a pullback, but remember, we talked about it just a few seconds ago, where this created a higher high. Prices couldn't get lower than this level here, so this is a lower high. Prices went up, created a new high, came down, couldn't get below these three levels here, and prices continue to go up. However, as prices hit this level of resistance, it couldn't get higher, and then eventually this downside on the right-hand side has broken those previous lows. So now we're entering into this sort of short-term downtrend, right? Every time it goes back up, it doesn't go higher than the previous highs. Hopefully that explains, how to sort of look at charts, just from a pure visual perspective, and say to yourself, am I in an uptrend, downtrend, or sideways? And if you can answer that question quite quickly, then everything you do after that is really looking to see how you can take an advantage of that opportunity, knowing in this example, you're in a downtrend. Now, not necessarily suggesting you sell here, but you'd be looking to sell when these previous lows, I'm hoping you can see my cursor, which I'm trying to point to the areas that I'm focusing on. I'm not sure if you can see that, but essentially, as soon as these lows break through these previous lows, that's your first indication, right, that you have this uptrend has finished, and the sideways box here, if you like, and I'll show you that on live charts in a second, has also moved forward. Just give me 1 second. Just want to check something for me. Right, wanted to double check something. Right, so that's support and resistance. We've just talked about high highs, low lows. We talked about resistance. We talked about support, and all of these we're going to apply, to our charts very shortly. So the other thing that we want to look at is trend lines. We want to see, and I often get asked, what do you use in your trading? Do you use these fancy indicators? Do you use all these types of things that you see marketed and what have you? And the simple answer is no. I've gone all the way back just to looking at support, resistance, trend lines, channels, and I don't even use indicators, but I will use indicators just to show you a couple of things which I've noticed on gold, which might be helpful to you. So drawing trend lines on charts, again, some people say it's subjective, and I say, no, it's not. What you're trying to do with a trend line is not necessarily trying to, for example, in this case here, we're trying to, hit every single point. What we're trying to do is get an indication that prices haven't broke higher than the previous high. So remember, the first thing we talked about, higher high here, but then prices came down to create a low. This move up, I really hope that you can see my cursor. I don't know if anybody can put in the chat whether they can see my cursor. If you can just let me know in the chat whether you can see my cursor, because that will be helpful, because I'm pointing to specific things. But anyway, back to the point, right? It creates a higher high here, obviously from previous uptrend. Prices came down, and when prices, and I'm pointing, I wish I had a cursor on here. I think hopefully, can anybody just say that they can see my cursor, because that will be helpful to me. Let me just look on the chat. No. Anyway, prices, when they came back up, they didn't come. I'm just checking my things here. Yeah, so when prices created this high, came down, and then this move up didn't go higher than the previous high. And I'm looking right on the left-hand side of the screen. And then prices came down and they broke through the previous low. And when it broke through, it continued going down. And then when the reaction up, or the pullback, didn't go past the previous high. And it's kept in that downward trend until such time, and that's why the red line is there. It's connecting some of the peaks, but essentially, once that trend line has been broken, we then go into a sideways pattern, and then prices start to go back up, and then we can commence our uptrend, where as soon as prices created new higher highs and the lows weren't as low as the previous low, then we can start talking to ourselves about an uptrend. Remember, I'm just doing the theory side first. We're going to apply it to live charts in a second. So here we can see the high. In fact, I might just use this. So this high here, this high on the second arrow didn't go higher than the previous high. And then again, this high from this red point didn't go higher than the previous high. And hopefully, once you start seeing once you start seeing these high highs and low lows, you can't unsee them. You see them, at a glance when you're looking at charts, and that's quite helpful because remember, as I said, what we're trying to do is when we look for a trading opportunity, we want to have some sort of bias in our mind. Are we in an uptrend? Are we in a downtrend? Or are we going sideways? So these are all important things when looking for the trading opportunity that you are looking for, regardless of the time frame. And so we've done support, we've done resistance, we've done trend lines. Now let's have a look at channels, because in many ways, channels are support and resistance, but just sideways. So what I mean by that, this is resistance, 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 and support is here, support is here, support is here. And you can see each time it creates a high, it didn't go past the previous high, and this low was broken to continue the downtrend. And as it went up, it didn't go as high as the previous high. And therefore, just by looking at these charts, we can see that this channel can also provide turning points for us. Remember the first chart I showed you with all those TPs? The turning points are very useful to us when we're trying to identify where the best place to enter the markets. And if we were counter trending, we'd be looking at the green arrows to buy. But if we're trading with the trend, we're only looking to take trades when those red arrows appear. And in the same vein, on the uptrend, we're seeing where markets couldn't get higher than the previous high. And and that's effectively resistance. And the support is that every time it came down to this bottom part of the channel, prices came back up again. And that's the support. I'll do a little bit on fibs, but fib again is another sort of half an hour, 45-minute webinar, which I won't have time to do. Those that you don't know too much about Fibonacci, there's plenty of videos on YouTube about what Fibonacci is. But the main ratios that I look for is the 61.8, the 50%, and the 38. I sometimes look at the 23, usually in a trend, but I won't spend too much time on that today. And I know people always ask me about moving averages, so I will talk a little bit about moving averages, Bollinger Bands, and I think I've got the MACD set up on the chart as well. And we'll look at how they are also providing support and resistance. For example, this moving average here, although it looks like it's not providing that much in terms of interest, once we start looking at it, again, from the same principle of resistance, right? It's hit the top of the moving average and came down. Every time it hit the top of the moving average, it came down, came down, came down. So that's where we'd be looking possibly, to put our sell orders in line with the moving average. I can't remember what this moving average is, but don't worry, we're going to look at some moving averages on charts very, very shortly. And again, once price breaks above the moving average, we can see that it then starts acting as support. So this is kind of like a dynamic support and resistance because it's being generated by the moving average that's helping us to determine, possible entry points bouncing off these different levels. And once it breaks down, then we're looking at resistance again on the far right. We can see how that works. And Bollinger Bands. I'll put a Bollinger Band up on gold and we'll see where we are in terms of the Bollinger Band. But Bollinger Band does a very similar kind of thing. Look, hit the top of the Bollinger Band, resistance. And what is a Bollinger Band? A Bollinger Band is effectively an indicator of volatility. When the Bollinger Band squeezes, it means that markets technically are going sideways. And when it expands, it means price is expanding and therefore trending. So you can utilize Bollinger Bands for those two. Once it stops hitting the top and bottom of its support and resistance, you can start looking as a possible tool to help you find ways to, get into a trend effectively. But it can be used both ways. You can use them as support resistance, or you can use them as breakouts of, of a trend after a level of support and resistance. We're going to look at, we're about halfway through, which is perfect, bang on time. We're going to apply these theories in real-time charts in a second, specifically on gold. But before I do, I'm going to be using Trade Torex as a broker because effectively they're regulated, they're global. I think I've got a question. Let me see if I can get a question here. Can we combine fundamentals with Fibonacci's? Absolutely. So we'll talk about fundamentals and Fibonacci. That's from Mr. Ahmed. Thank you for the question. I will, once I go to live chart, I'll show you how the fundamentals also affect price. In fact, just last week when we had non-farm payroll, which was an important indicator in the US, we can see how gold reacted to that. We've got, although the GBP just had an interest rate announcement just a couple of hours ago, we can also see if anything happened there, but unlikely because the dollar is the main driving factor for gold. So let's just pull that down. So as I said, make sure you take a look at the Trade Torex website. They're a good broker, and they sponsored this particular webinar. So let's have a look at live charts. So let me see if I can pull my charts up. Just bear with me for a second. Right, hopefully you can see my charts. And I'm going to move some of these tools out of the way so they don't get in my way. Can everybody see my charts? Just put yes in the chat box, and then I'll sort of go from there. Just want to make sure you see my charts. Let's have a look. There's somebody answered. Yes, perfect. Thank you. Thank you very much. Right, so what have I got here? Let me move some of these tools out of the way because I want to try to use the maximum chart part of it. Let's get this out of the way. Right, so what have we got here? So I'm looking at the daily chart of gold, and the symbol for gold is XAU USD. Some of you who've traded before probably know that anyway, but when you're trading CFDs, this is the symbol for gold. When you're trading futures, it's a different symbol, but we're mainly going to focus on CFDs. I'm using the Torex live account here just to data and for my trading, generally speaking. So let's get rid of these lines, and I'll show you how I put these, and I'll do that with every single chart because we've got about 6 or 7 charts to look at, and from that we'll determine, what we think is going to happen next. So I've got this rather annoying zoom tool, which I need to just see if I can find a place for it that doesn't interfere with anything. Right, okay, so let's just not spend too much time on that. If I go back as far as I can go back, right? So this is, each candlestick is daily. This is going back to March 2020. And hopefully, right, daily chart, even with just the knowledge we've just, gathered in the last half an hour or so, you'll see areas where prices are trending. You'll see where prices are hitting levels of resistance, 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 resistance. And again, we're looking at higher highs. And when this low came, it didn't go lower than the previous low. If I magnify that. So everything I'm showing you from the previous slides is what you see here, right? So prices shot up, they broke through resistance. So when we had resistance, buyers at this time and this time were not interested in taking price higher. Once it broke through, it went up, came down, but didn't come lower than the previous. In fact, I can put the cursor on here so you can see what I'm pointing at. So we've had this resistance, eventually broke through. The resistance was drawn, by the way, just so that you know, because we had two levels here. We've had price shot up and came down, shot up and came down, shot up and came down. You might say, so why didn't you put your resistance line here? Because this was a spike. And although a spike is important, if I remember this particular spike, it only happened for a very, very short period of time. So I consider that not to be the resistance. I consider this to be the resistance, where prices over a sustained period couldn't get past this point here. But eventually, buyers pushed the price up and it started a new uptrend, right? So high. And if I go down to smaller time frames, you'll see that even more clearly when I look here. Second. So once we broke through this resistance, remember we just talked about these highs, higher high. This low didn't go below here. This high broke through this high. This low didn't go below low here. And then it just created new highs with lows not being lower than the previous low until such time it created a resistance level. If I go back to the day level, day price, we can see, and if I can draw a line across here, we can see that 24.26 is a resistance level. In fact, I could probably go a little bit higher, probably about 24.31. Yes, we had a spike, but again, anybody who follows gold, from a really close day-by-day perspective, that spike was literally, no time at all, basically. So I consider this to be resistance. So what am I saying? Once we have this resistance in play, we need this resistance to break to confirm to us, right, that buyers are interested in buying. And the other important thing to understand is, and I'll go to this slide here where I've drawn a couple of levels. Let me get rid of some of these lines. I don't want them to be confusing you. This green line is just really showing a potential of head and shoulders, but we haven't got the second part of the shoulder. And I don't believe the shoulder will occur because I think, that from a fundamental basis, I'm been asked about that, what are the fundamentals about this? Well, one of the fundamental rules about gold is that because it's a limited quantity of gold, that's been mined, and it's getting harder and harder to find, more and more gold. So when you have scarcity, the fundamentals always indicate that the value will go up. Now, there are other fundamental factors that are affecting price of gold in terms of why does it keep going up. It's because it's often used as a protection against inflation, a protection against, the fall in the dollar and what have you. So all these kind of factors, different traders, different institutions will use gold in a slightly different way. But overall, if you span the charts over many, many years, you'll see that it continues going up. Not to say it doesn't come down, right? It definitely does. But overall, over a longer term period, and from a fundamental basis, of the things we've just discussed, it does have a tendency to go up because of the scarcity. Right, so what are these two orange blocks? So what these two orange blocks, remember we talked earlier in the I think I've got a question here. Can you explain the relationship between gold and the US dollar? For me to explain the relationship between gold and dollar, I'd have to go back to 1976 with Nixon when they removed the gold standard, because the gold that was stored by the US was always backed. Let me reverse it the other way around. Each dollar back, in those days, pre 1976, each dollar was backed by an equivalent value of gold. So they had to hold a certain amount of reserves to print and issue dollars. Now, clearly, what's happened in the last 20 years is that relationship has evaporated, meaning that when they got rid of the gold standard, that the dollar was no longer backed by gold as a physical commodity. It's then backed by a promise of the US government promising to make sure that they will back the value of gold. So the relationship between gold and dollar goes back quite some time. It goes back even further if you look at the history of gold utilized by the Romans, and before then as a precious metal. It was used as a currency, right? So it's a very deep and long topic. I don't really have time to sort of talk about that, but in terms of the value of the dollar and the value of gold, well, gold is valued in dollars. In this particular example, it says XAU USD. So they're pricing this derivative, this future, the value of gold in US dollars. And the movement of the dollar itself independently clearly has an impact on gold, because the less the value of the dollar, the more you have to pay for your gold, which, remember, we talked about being a scarcity or more scarce commodity, and utilized for safety, inflation hedging, and all sorts of things that go into play. Then you can understand this. So you can understand it's a complex topic. The way that I would kind of answer it, really in a very simplistic way, is if you look at the dollar index and look at the relationship between the dollar index and the correlation between gold, you might get some sort of inference in terms of the true value of gold, as opposed to the dollar index, which is supposed to be an index purely showing the value of gold, the value of the dollar in relation to other things other than just gold. And then you can get a bit of a correlation. So if you want to deep dive into the correlation between gold and dollar, which was the question, it's a deep dive, right? You need to go quite deep into that side of it. Today, we're really just focusing on the technical side, because the way that I view technicals against fundamentals is all the fundamental news that is out there right now has already priced in, and the value of gold right now at 23.44 has every fundamental part built into it for this second, right? And for the next second. And if something happens, whether it's an increase in war in Ukraine, that will move the price from a fundamental point of view to a technical point of view, and we'll see that price being reflected in the chart. So I hope that answers the question. When I look at trading, I tend to look at the charts, because, as I just said, all the fundamental news is already built into right now. 23.44.77 has, at this moment in time, all the fundamental news built into it, right? And what happens in the next 1 second, 2 second, 5 second, 1 hour, 5 days, the fundamental news will already have been factored into it. I hope that makes sense. Does that make sense? I hope it does. Maybe you were looking for a different answer in terms of the technical relationship between the value of the US dollar index and the precious metal that is gold. Say, all these topics are fascinating to me, but they require an in-depth discussion, talking about the influences that moves the dollar and the influences that move gold, and their interrelationship between the two. So these boxes that I've just sort of generated here, I'm trying to find, at the moment, right, the box, and remember, going back to the initial slides, the market's either going up down, sideways. From my perspective, from a daily perspective, price of gold against the US dollar is trapped between these two levels here. It's trapped between 24.33 and 22.80. Now you might say to yourself, well, wow, that's a big range to be worried about. How do we take an opportunity for trading that? Well, the basic concept is what I'm trying to do, and certainly if I'm trying to look at it from a daily perspective, for the next 1 week, 1 month, 3 months, right? I need to know, because remember, if each of these candles are 1 day, I want to see what is going to happen to the value of the commodity that I've just bought, whether it's a CFD or whatever. I want to see, what is its range between now and 3 months' time. And because it's trapped between these two boundaries here, I don't know, and nobody does, I promise you, because if they did, they would be hoarding gold like crazy. If this price at 22.79, its support level, we talked about support, because every time prices came down, they went up. Every time price came down, they went up. And where do they go up to? Well, from a larger term perspective, they came up to this level here, 24.36. But more recently, it found a level of resistance at 23.81. So we're now starting to narrow down our window of uncertainty, because once it's in a trend, it's easy, right? And when I say easy to say, I guess. I've got a couple more questions. Let me just make sure I answer. Which technical analysis tool do you find most helpful in gold trading? Mr. Lim, I'm using the exact tools that I use in trading. People often use all sorts of fancy, and I'm going to go into them. Look, over the next, and I'm running out of time, we're going to look at some indicators, we're going to look at fibs, and we're going to look at Bollinger Bands, right? But if you ask me a blunt question like that, what tools do I use? I'm going to tell you bluntly, I use support, resistance, channels, and I utilize the higher high, lower lows. That's all you ever need. And well, sorry, I'll rephrase that. That's all I ever need. Because I know these turning points that we talked about earlier on in the conversation, I want to know not where I think the turning point is. The market is telling me where the turning point is. The turning point is here. It's here. It's here. It's here. So once I've established the turning points, that will help me in my decision-making process. So the blunt answer is the tools you're seeing are all the tools. It's price action, it's support resistance, it's trend lines, it's high highs, lower lows, and trying to use, and I do use Fibonacci's mainly for targets. And I'm going to go into fibs in a second. So let's move on to some of the other things that we can use. So this is a channel. Remember, we looked on the earlier slides. Sorry if I'm speeding up, but I'm going to try to get everything I can in 10 minutes. So we saw that the price turned here, came to the bottom of the channel, went up. Note, it doesn't come exactly to that channel, but I don't care, because I'm trying to find the direction. I'm not trying to find, the exact point this turnaround. So once buyers came in here and they broke this previous high, that's an opportunity to buy. And it did go up, even though the pullback came here. Let me make sure that you know what I'm looking at, right? So we saw here, prices went up, they came down, they couldn't get past this point here. So we had an opportunity to buy. It did indeed go up, did have a pullback, but because we're a buyer, because we believe fundamentally that gold will continue going up, we hold it. And price is going up. And by the way, full disclosure, which I mentioned earlier, I'm a buyer of gold. I think gold's going up, and there are several fundamental factors for that, and there are also technical factors for that, which is what I'm going to kind of cover. Obviously, where to enter, that's another topic, but I'm going to talk about the possible ways you can look to enter with the thesis that it's either going, in the direction that you've analyzed, i.e. up. Does that answer your question? Kim, hopefully it does. And this is going to go up. It might find some resistance here, but if I'm in around here and I've got my stop losses, right? I'm in even though in the downside, I have confidence, or I would have had confidence, that because I'm in an up channel, eventually it would turn around. I know I would be wrong if this low gets broken, this low here, because then using the same principle we just used a few seconds ago, higher highs, lower lows, kicks into play, right? Now, remember, I'm looking at long-term charts, or daily charts, I should say, but it applies equally whether you're doing a 5-minute chart or a 1-minute chart. You know, the same things appear. If I get time, I'll show you that too. Right, so what's the best way to manage risk when trading gold? Yeah, so risk is an important topic. And again, it kind of glides into this area here. And I'm never a great person who says, you know, coulda, shoulda, woulda bought here, blah, blah, blah. But it marries up with our analysis, right? We've seen that price didn't go below here, and effectively it's gone up, right? So where would my stop losses be? And I'm doing this very crudely, by the way. On, you know, when I do my mentorships and stuff, I go much deeper into it. The stop loss depends upon how much or the value of your account and your trade size. You want to make sure that when you're trading gold, that you have enough to risk prices having a pullback. For example, they pulled back here. You know, if you hadn't managed your risk properly, you know, and your risk was still here, then you would get stopped out. In this case, you'd probably still get stopped out with a bit of profit, but it's holding it for a decent period of time. Trade sizing is really obviously important, because depending on the margin and leverage levels, which I don't have time to cover here, then effectively, you know, providing your trade size is proportionate to your account size, then you just leave it, let it go, basically. You know, just let it do what it needs to do. Your stop loss is here in case you're wrong. Where you're wrong is when this low gets broken, because remember, once a low gets broken, then theoretically either the market's going to go sideways or a new trend will start to emerge. And you don't want to be long when the new downtrend starts to emerge. Let's see if there's any more questions. Great. Okay, let's cover some of the other tools. That's channels, right? So fibs. Fibs are popular, and you know they're good. I tell you, I only use fibs really for targets. I don't use them necessarily for entry points, because I use other things that we just talked about to determine my entry points. I look at fib levels. For example, let me just move this little box out of the way for a second. Let me just get rid of it. So what is this? This is a fib that was generated. In fact, why don't I just start again so you can see it? Let's delete that. So what do we see, right? We've already kind of established that we have some resistance. In fact, I'll just start drawing exactly like I would do at any moment in time, right? I can see where my support and resistance are. They're not just support and resistance, they are supply and demand levels. Price is above here, no demand, right? Here, there's no supply because buyers keep buying at this price here. So supply and demand is a factor. I think one of the questions earlier was about fundamentals, right? So what is this telling me right now? It's telling me that we are bound sideways because it's not creating any new higher highs or higher lows. You could create an argument, right, that says, which this argument will disappear very shortly, is that this high hasn't gone down further here, and this low was lower than this low. However, this low was not lower than this level, right? So we're still strong on the upside because, and as soon as this gets broken, I think that's where I had my boxes on my previous thing here. Once this box gets broken, I'll be adding to my positions with a caution at the top orange line, because that's a level of resistance. And so you can utilize these support and resistance and levels to either use as trade management ideas. You know, once you hit a level here, you might think, okay, is it going to break through? Because nobody knows, right? It could just burst through here. And if you put your target here, that's not always the best thing to do. The best thing to do is put a target below it. And then if it does break through, then you can kind of follow or trail price going up. The fact that we've been going sideways for quite some time, right? It's a little bit of uncertainty whether price is going to break through here or going to fall through here. We don't know. What will be a key indicator for me is that will it break through? If it breaks through here, then for me, there's an even more stronger case, to be buying. But right now, we're approaching it. We're probably about $30 away from it. Let's have a look. Let me just check the questions again. Yeah, let's see if I can. So, just to answer one of the questions I've just seen again, how do you manage risk? Managing risk is using stop losses. It's utilizing trade sizing that doesn't blow your account if it moves, more than a few dollars against you. So I do webinars on how to calculate dependent upon your account size, dependent upon leverage, dependent upon all sorts of things. So managing risk is to do with trade sizing. It's to use stop losses. It's to use trading stop losses when price is going your direction, having to move it up accordingly. What else did I want to show you? I've only got about 3 minutes left. Now, moving averages are not my most favorite tool, but we talked about support and resistance on moving averages. Just for understanding, right? This is the red line is a 200 moving average. This is a 100 moving average and a 50 moving average. Why those particular moving averages? Well, having been trading for 20 plus years, they seem to be the most common and not the only moving average that you use. But you can see here, it's acted. Let me get rid of this lock here. It's acted at a level of support. Support, once it breaks through the resistance here, it comes back to the 50 moving average, and it's been bouncing on there, for the last 10 days or so, and it's bounced. Another reason, why you want to be buying. I've also got here, which I'll leave you with probably because I'm running out of time, unfortunately, is a MACD. Again, I just spent some time telling you I'm not really a big fan of, various indicators, but one of the things that I do look at is divergence and convergence. And when you have MACD, and I'll try to explain this in just a few minutes, we can see this peak here. In fact, let's go one peak before that. So you can see this peak on price, peak on MACD, came down, created another peak, which was another peak here. However, the MACD fell significantly, but price held up, right? That means that price is diverging away from the moving averages. And again, it's another indication that there's strength. And how I can sort of illustrate that a bit better for you is, let's see if we can find another example. Another example here is that we had a peak here, peak. We had prices go below, and that was below as well. This may not be the best example. Let's see if I can find a better example. Divergence, convergence. So that peak corresponding with that went higher than that. I can't actually spot one now, unfortunately. So we have peak. What I'm trying to do is trying to give you an old example where the peak was lower than the previous peak, which is an indication, right, that although price is sort of holding up, the MACD is not only can come down below the zero line, it's now starting to go back up again. And that's what we can see here. So those of you who are looking for some trading ideas, which, remember, I can't give sort of investment advice, but what I can do is just tell you what I see. And what I see here is once this breaks, once this closes above this trend line here, and indeed for safety, if it breaks through this level here, then it's most certain. I've got to be careful what I say on a webinar, but I'd be looking for price to not only break through here, but break through here. That's how I see it. So when we're looking for opportunities, there is an opportunity here. It's bouncing off the moving average in this case. Did I have anything else to show you? Yeah, Bollinger Bands. I'm running out of time, and if the recording stops, I just want to say thank you for coming. But I just want to finish off with these volatility. Like, so for example, here, Bollinger Bands. When it squeezes, remember I said it earlier, when it squeezes and expands. When it squeezes, it means it's in sideways. When it expands, it means a trend's in place. So what are we seeing here? Let's see what we can see right now. We can see here that it's basically bouncing from the top here, from the bottom here, from the top here. And again, it coincides with what we're already saying to ourselves, is that if it breaks through here, then this Bollinger Band will start expanding and a new trend could theoretically start, with the caveat that we have some levels of resistance here and a level of resistance. Well, they're the two levels of resistance that we'll be looking for, this one and this one. I do apologize, but I think I've run out of time. It's a pity, but I wanted to show you. Let's see if I can. Let's just see if I can get this here. Back to the presentation. We've just looked at live charts. I wish I could spend another hour with you guys sort of going through it. But if you do have any questions, contact me at Everything Trading. I'm always happy to help those of you who are interested. I appreciate your questions, and I really do enjoy these. And please, our sponsor paid for me doing this and for you guys to be here. So do drop by TradeTorex's website, sign up for an account, and then when we do these webinars, you'll get notified well in advance. So I appreciate everybody being here. And when will you send the presentation? Just I don't know how you joined us. Are you already with Mr. Ahmed? Are you with TradeTorex already? If you are, then speak to your sort of sales representative, and I'm sure they'll get this presentation over to you and help you out. I'm always there to kind of help where I can. I really do have to go now, and I appreciate everybody's time, and see you on the next one, I hope.